Goldman Sachs posted a report unveiling their higher target call, which was 3,100 up to 3,300. In doing that, they added an upside price spike tail, which said that gold could easily go to 4,500.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and this is the Gold Fix Morning Market Rundown. Gold is up $35 today, and we're going to tell you exactly why it's up today and why it will probably continue going up for the next 6 months to year. Knock on wood. The title is Gold Unshackled as Goldman adds 4,500 to upside target. Yesterday, we previewed for founders a report from Bank of America unveiling their reasons for a 3,500 target between now and the end of the year. And then yesterday, Goldman Sachs posted a report unveiling their higher target call, which was 3,100 up to 3,300. In doing that, they added an upside price spike tail, which said that gold could easily go to 4,500, depending on a confluence of events and how things piled in. We're going to touch on both of those reports today as a preview of full analysis coming tomorrow and over the weekend for premium subscribers. For now, let's give you a little bit of a summary of what the situation is. First, the markets. 10-year yields are 4.39, up about 3 or 4. The dollar is 104.33, down 33. The S&P 500 is 57.05, up a handle. The VIX is 18.57, up 25. Gold is 30.53, up $35, a little less than 35 right now. Silver is 34.12, up 50 cents, up 1.5%. Copper is 5.19, down a little less than a penny, down almost nothing. WTI is 69.81, down 40 cents, give or take. Natural gas is 378, down 6 cents. Bitcoin is 86 spot 900, unchanged bid essentially. Palladium is 977, up 11 and change. Platinum is 975, unchanged offered. Gold, silver stable at 89 and change. Soybeans 997, up 5. Corn 443, up a little less than 1. Wheat is 543, up 1. There's the front page. That's some of the work products we put out yesterday. First look, that was for founders. Bank of America raises the bar and soon their price on gold. We wanted to hold off on their price target being raised and kind of unveil that, but Goldman forced our hand. Top left-hand side, the rally gold advocates did not predict again. That's an editorial piece based on history and information and how we read reports, specifically the World Gold Council's report. And then the lower left was the Gold Fix PM, which is a compendium of the work of the day, which featured a report, an analysis, our analysis of the April 2nd tariffs and what they mean. If you're trying to figure it out in a nutshell while avoiding the 50 million headlines that are out there. So that was our work product yesterday. That's what we're going to talk about. Oh, again, total of yesterday's work. The rally gold advocates didn't predict again. JP Morgan upgrades miners and Goldman sees more copper upside yesterday. First look, Bank of America raises bar. We just mentioned that. Tariffs, we just mentioned that, and there's the compendium. In the last week, there have been about 6 reports coming out, and that's why one of the reasons we use the word unshackled. Before we do the markets recap, let's get to the main event, okay? In a report put out yesterday, Bank of America says gold at 3,500 an ounce. We believe gold could rally to 3,500 an ounce if investment demand increases by 10%. So we make this our new price forecast. The report then proceeds to go into why that will happen without being obnoxious about it. Goldman Sachs today says we raise our end of 2025 forecast to 3,300 a troy ounce versus 3,100. And our forecast ranges 32 to 35.20. That's their low to high normal baseline. In extreme, this is the new part. In extreme tail scenarios, gold could plausibly trade above 4,200 an ounce by end of 2025 and exceed 4,500 an ounce within the next 12 months. So 4,500 an ounce by Q1 of 2026. On your screen, you see on the left-hand side, that's Bank of America's forecast, simplified. And on the right-hand side, that's becoming a very popular graphic in our community. That's the Goldman Sachs forecast. Now, both of these forecasts, without going off on too much of a rabbit hole, are based on things that are near and dear to our original career's heart, fundamental analysis. They're quantifying central bank demand. They're quantifying how much can be put into central bank buying. They're quantifying the insurance industry. They're quantifying ETF flows. And they're doing so rather transparently. And we're very happy to see it. And we're probably happy for their analysts, not necessarily the bank executives, but their analysts finally have something interesting to write about with gold. Okay, we say gold is now unshackled. Once a proxy for the dollar and interest rates, the metal is free to find a price that reflects actual global demand. Our own price targets that reflect some of the things discussed here were revealed March 14th, where we offered 3,600 to 4,285 as price targets. We'll touch on that a little bit later on. The major banks, long tethered to traditional models, are similarly unshackled in their analysis. What was once viewed as a sleepy, correlated asset is now being subjected to fundamental analysis. Analysts are translating measurable demand into constrained supply and developing legitimate price projections. While some of their sentiment might appear euphoric in the short term, it's not fantasy. It's based on tangible demand that has emerged and been unlocked. And now the big banks are playing to their strengths beyond anticipating customer order flow. Their core strength lies in quantifying an objective. We're seeing that in real time. In just the past 24 hours, as we're discussing now, Bank of America and Goldman Sachs have announced raised price targets for gold. Let's start with Bank of America. Bank of America's view is, well, they revised their target and it builds on a theme they introduced last month. Their key idea is if Chinese insurance companies are permitted to purchase gold for both their balance sheets and client-facing products, how much could they realistically buy? And what impact would that have on price? That's one of the focuses of their main report. Another key area, arguably more innovative, at least so far, is Bank of America's further quantification of potential central bank purchases in the current geopolitical environment. Presently, central banks hold approximately 10% of their reserves in gold. Bank of America presents a case that this share could climb towards and reach 30%. Bank of America says this and justifies this projection and explain its relevance. They openly discuss the risks involved. We agree this is where things are headed, relying on efficient frontier type analysis. The sweet spot for central bank unhedged ownership is around 25 to 30% by our calculations. Essentially, a little bit off script here for a second. The conversation for the past 2 years has been de-dollarization. The conversation at the banks for the past year, 6 months, has been de-dollarization. Nobody is questioning that anymore. Now what they're saying is, how de-dollarized will central banks get? And the answer is, if they want to achieve efficient frontier portfolio balance going forward, that number, Bank of America says, is about 30%. We agree. It will probably be more than that if they start utilizing hedging. But let's stick with 25 to 30% for now. It's worth noting that the Chinese insurance company gold purchases are economically separate from central bank buying. Here are the nuts and bolts of that portion of it. China has initiated a pilot program allowing major insurance companies to purchase gold, both for their own balance sheets and for client investment products. We alluded to that earlier. Goldfix believes domestic insurers have earmarked about $25 billion to be invested into gold per the mandate rules of the pilot program. We also believe they will put that in there faster rather than slower. Why? Because China's interest rates are so low that the demand for higher yielding yet safe products mandates from the client base, we want something that also doesn't have a high interest rate, right? But gives us safety. So the concept of opportunity cost factors in very big in China now. Putting concrete numbers behind this, Bank of America believes 300 tons of gold purchases, or 6.5% of the annual physical market's production, would be taken off market. Now, we have a rule that we learned from Victor Niederhofer years ago. We had dinner with the guy. He said a 5% decrease in supply equals a 20% increase in price as a rule of thumb. And we got into all the reasons for it. So 6.5% off of physical supply, let's call it 5%, if the insurance companies were to make good on their purchases, which we believe they will. 1% is what they're permitted, and 1% is what they're probably going to do. It will take 5 to 6.5% off the market. That would add about 20% to price. That's $600. We still think Bank of America is holding back on their price target, perhaps because they want to be careful, perhaps because there are other bullion banks with exposure. We'll never know, but that's the point. This move, we contend, okay, is akin to Ronald Reagan's early 1980s decision to liberalize stock ownership for U.S. insurance companies. That policy helped trigger what became the largest equity bull market of all time. We are arguably still in it. We cannot emphasize this parallel enough. China is replicating U.S. financialization while we're replicating their manufacturing. And in replicating U.S. financialization, the steps mean liberalizing ownership of an asset that you wish to be bought by your people. In the U.S., it was equities. Right now in China, it's gold. Why gold? Well, it's because they're tying their currency to gold. So U.S. financialization applied in China, but they're doing it with gold. I cannot emphasize how important this is. You're taking a whole industry and you're saying it's okay to own gold. In fact, it's okay for you to own seats on the exchange that have the gold. In fact, it's okay for you to offer products and create products tied to physical gold for your clients who no longer are interested in bonds, but are still a little bit too scared to buy stocks outright. Next. Moving on to gold, Goldman Sachs. We raise our end of 2025 forecast to 3,300 an ounce versus 3,100 an ounce, and our forecast range from 3,250 to 3,520, restating what we said at the top. This reflects upside surprises in ETF inflows and in continued strong central bank gold demand. That's interesting, off script. Upside surprises in ETF flows. Well, it's not so much the surprises in flows coming in. We're still well below where we should be in ETF buying. It's the surprises in how the market reacts when those ETF flows stop. And the market keeps going up when the ETF longs are selling. And that means central banks are no longer buying the floor, they're buying the fair value of the market. Goldman just raised their year-end target from 3,100, as we said, to their prior conservative target, to 3,300. That's their new prior conservative target. Notably, they were among the first banks to publish a quantification framework for gold demand, detailing the flows from over-the-counter markets in Europe, specifically from London to Switzerland and beyond. Beyond meaning it went over to China and the Asian central banks. They applied a methodology where a specific amount of demand equals a projected increase in price, supported with real delivery and off-take data. Nowcast is the model that they use to get the data. From our experience in quant models, we thought their numbers were actually conservative. 2 weeks ago, we published our own target, also grounded in fundamentals, a little slightly different than theirs, but we projected 3,600 and 42.85. Those are odd numbers, yes, but that's what the numbers told us. We said back then, based on ETF flows, which is what Goldman is focusing on again, we should see an additional $600 and possibly $1,285 to current prices. This is when we broke 3,000, placing the price between 3,600 and 42.85 when those ETF levels are reached, assuming no significant decline or increase in central bank buying. That's what we said. Let's go back to what Goldman said. When they first revealed their new valuation methodology about 4 months ago, it faced pushback. Some banks resisted, citing Fed rate hikes and a strong dollar as headwinds that would eventually cap gold's rise and probably cause its demise, at least short term. But even those banks began to adjust, especially after seeing continued and surprising central bank buying post-US elections. The scale of those purchases is forcing a reevaluation. Today, Goldman Sachs not only reaffirmed, here's the big stuff, not only reaffirmed their 3,300 target, revised, I should say, their 3,300 target, they also upped their aggressive case from 3,500 to 4,500. That new projection is based on 3 factors, okay? First, China. They now anticipate even stronger Chinese demand than previously modeled. Note, they were very conservative post-election, and that arrow just keeps creeping higher. Quote, if the largest official buyer, China, were targeting an allocation of 20% and maintained an average pace of around 40 tons per month in line with recent patterns, we estimate it would take approximately 3 years to reach a 20% gold share. China's going to be in the market for 3 years, unless they decide to buy it tomorrow, and then we get 4,500 an ounce. Insurance companies, echoing what Bank of America said, they also now publicly acknowledge that insurance company gold buying angle, as Bank of America already has, discussing using their math, saying a 1% increase in gold holdings, which is what these insurance companies are going to do, adds a percentage to the gold demand. They actually break it down where the demand is and how it adds to price. The third one is Western buying, which every bank has discussed, but I think Goldman has been really on top of, perhaps with Citibank as well. We don't see as much of their insights. We wish we did. Quote, over the span of 6 weeks, and here's the key, speculative length declined by 150 tons, yet prices remained supported by structural demand, including a notable pickup in gold ETF inflows, around 80 tons. What we estimated to be ongoing central bank buying amid rising U.S. policy uncertainty. Now, we will get into why and what and the details of this another time, but it really comes down to this. The West, at the institutional level, is buying and trading gold. They're buying the dip, they're buying the rally, they're selling the next higher rally. ETF flows are becoming more consistent from Western investors, and Americans are looking at dollar correlations again. When the dollar gets weaker, they buy 5 contracts. When the dollar gets stronger, they sell 3 contracts. So the correlation is back at a higher level, but it's really working as a net upside kicker for the market. And that's because you can thank the previous administration, and you can thank COVID, and you can thank anyone else you want in a partisan political fashion, but that's because the nation has been reacclimated to the fear of inflation, has been reacclimated or acclimated to the fact that we could theoretically default on our debt. We have too much debt. The nation has also been shocked very recently into looking at their Mag 7 stocks, their AI stocks, as being overvalued. And there's a demand for alternatives that are not US Treasuries, not just overseas, but domestically. Okay, I don't care how high the rates are in the US. 4% is not enough. A portion of my money is going to go into gold. A portion of my money is going to go out of tech stocks. We'll show you a chart of that later on. So Goldman also released a detailed, very good, 10-question framework to explain their rationale. They basically took their report and they put it in a Q&A, and it's much easier to deal with. We'll be sharing that with premium subscribers over the weekend. What's next? What's next? Today around noon, the full Bank of America analysis will be released. Friday, we will probably do a walkthrough of the Bank of America report because it's very long and it has a lot of factors in it that we've touched on and a lot of factors that they don't elaborate on that might be worth it. Kind of like going through a HeartNet report. It'll also have added insights and context. This weekend, we will do a deep dive into Goldman's updated report and their 10-question valuation framework. Moving on. Now, before we go into the rest of the broadcast, we want to show you something that is quite shocking if you've never seen it before. The candle chart is an ETF that is the Mag 7 replicated, and it started in, I think, February of 2024, maybe March, maybe January. So that's the lifetime of an ETF called MAGS, and it's tied to the Mag 7. The purple lavender line is the GDX ETF. Now, these are the majors. These aren't even the aggressive miners. From a 0 point, the day that the Mag 7 ETF started, to now, in the first week in March, we noted to subscribers that it was tied with the Mag 7 performance. And you can see it is now above the Mag 7 performance. And you could also see that starting in January of 25, the Mag 7 started to weaken and the whole convergence process started. We think that in the fiscal year starting in 2025 and going forward, little by little, everyone is saying, sell some tech, buy some gold. I don't want to buy gold. I want to buy gold miners because gold's already gone up. And we think, as we noted before the last week or so, that banks are going to start recommending gold miners because the client base is beating the drums for more alpha and more responsible alpha. We hope miners will respond by doing one of two things. They need to be responsible with their newfound excess cash, and that is they need to issue dividends or start buyback programs. We understand that for years they have been under the gun, and they still are under the gun financially in many ways, and that has caused them to be conservative with their spending, especially with the ramping up costs. We're asking them to consider changing that tone and at least issuing dividends because people want to buy miners now. They're looking for reasons. And I think the miners that respond to dividends or share buyback programs will probably garner the most interest and love from banks that are recommending them. Markets recap. Yesterday, stocks ended down while the dollar strengthened as traders awaited auto tariffs to be announced by President Trump. I believe those went into effect. Treasury yields, meanwhile, inched higher as investors weighed potential exemptions to those tariffs. Oil prices jumped on reports of a dip in U.S. crude oil inventories, and gold eased but remained above the 3,000 per ounce level. Case in point, the dollar stronger, gold drops a little bit, not much. What's the dollar down today? 40 basis points if you want to focus on the dollar. Gold's up $30. Okay. Correlations are there for all the people that love to talk about them. They're only there as excuses for Americans to buy now. In market news, X is to report its first annual ad revenue growth since Musk's takeover. Tesla is to launch in Saudi Arabia as Musk and the kingdom mend relations. Trump is likely to use 2019 probe to justify tariffs on auto imports, justifiably so. Microsoft pulls back from more data center leases in US and Europe, analysts say. That's significant in the sense that uh, TD Cowen on the equity side, they have an analyst there. We're not going to pretend we know everything about this. We have to read it. But Zero Hedge is all over it. TD has been saying that Microsoft is going to dump centers because it's not profitable, and that's been a headwind for AI stocks. Data centers are too expensive. But other companies are basically buying what Microsoft is selling, and now Microsoft is selling more, and Zero Hedge has that covered very well. That's it. Full disclosure, before we do the rest of this, I took delivery of a monster box and some American Eagles, some gold Eagles, yesterday, and there are about five. I'm not a big physical person. You have to understand that I don't buy physical. I stack it, but I don't buy physical on a dip. I buy futures on a dip, and when the market rallies, then I sell my futures out and I convert it to physical. It's kind of like I'm very tactical. So, a coin dealer is not going to get it to you tomorrow. But I have a list of about five firms that I work with, that I have worked with and will work with again. Now, I'm going to recommend those firms based on turnaround time. That's important to someone like me. Trust and security and personal attention. All their prices are competitive. You'll be able to shop price, which is easy to do. But I think the differentiating aspect will be, well, hopefully, if my word means anything, they got it to me in time. They got it to me as promised. Those type of things. And I will do business with them again. All right. So geopolitics and politics, you can work on that. Let's go to the charts. All right. There are no resistance levels in a bull market. Okay. We're working with multiple technical tools, and you guys are familiar with Michael Oliver's work, and we quote him from time to time, and we had a conversation with him yesterday, and we will be able to do that again continuously without cheapening his product. We'll just be discreet. On the other hand, there's another product out there we actually are using now, and that's called Polytrends, and it's owned by a guy named Trader Sumo. It's very tactical, but it gives good levels, and we're in the process of using it. We're finding that instead of doing the 2 hours of analysis that I have to do with my channels and my levels, I'm finding that more and more of his levels are very close to mine. Now, you can just look at that and you could say there are no levels above. There are only levels below. So if you're bearish, that's what you see. Now, I'm just going to hide that a little bit because I don't want people to be too distracted by it for now. And we'll talk about it more as we use it more. So here's a gold hourly chart. No, let's stay with the gold daily. I'll do this for you guys, right? All right. Let's start with silver, okay? To reiterate, I have said that this breakout above here, my lines are gone. Every time I refresh my screen, my lines disappear. Means the market should go to here. We have our alert there. Okay, we retested it. We got nervous, and now we're off to the races. We don't think that 35 will be a problem. We also think, if you zoom out a little bit, we'll do that in a little bit, that above 35 gets you 39, not a problem. So this resistance we have here, 34 and change, it's nothing. It's probably going to go above it. And if you want to look at it from a trend line point of view, here's a trend line, here's a trend line. So we'll pull back to this trend line maybe. Maybe we pull back to that trend line. But there are other factors you can look at. But I will say that silver is now behaving like gold. You get your 8 and 9s. Those are signs of oversought, kind of a slowing momentum indicator, and the market drops. But you're getting more and more V-shaped bottoms. Now, I want to tie the technicals to the fundamentals in silver. If on April 2nd, there's any back off in the tariffs this time, you will see gold, silver, and copper sell off. You should see gold sell off and recover. You should see silver sell off and not know what to do. You should see copper sell off and then sell off again. We're not sure. But just know that April 2nd, even though it's not a huge event, is a big enough event for you to say, hey, if it happens, I'm already long. And hey, if it doesn't happen, then I'll have a dip to buy. That's the way to look at it. Moving on to gold and the measured move concept. By the way, measured move, right? We're up to here. This is also a measured move. Above 33, above 34, let's call it, above 34, call it 34.20. Above 34.20, you can add another dollar. So this is a fractal. Look, Jordan and I looked at these in gold for over a year in gold, and we were looking at them going, here's a measured move, fractals within fractal. That's what we were seeing, like measured moves with it. I was going to hourlies and seeing the same thing. And they were very good for targets and for breathing moments as well. We're starting to see that in silver now. For example, measured move. Above that, we should go to, infinity. I'm not going to get into that right now. I'm looking at this. Measured move, $39. Measured move, $36. Okay? So above here, we go to 35. Above here, we go to 36. And above this one here, this is the one that I'm actually looking at, we go to $39. Okay? So, and of course, if the market's $1 lower, everyone can blame me for being wrong. But I'm telling you the levels. The levels are below 33 on a closing basis. You don't want to believe in what I'm telling you. Gold, on the other hand, is in the process of creating another measured move, right? Dip, measured move, break it, touch the target. Distance, depth equals distance. Depth equals distance. If we make a new all-time high here, you can add crazy. This is crazy. Say 30, call it 30, 33,000. You can add above 30.50 adds another $50 easy. Above 30.50 gets us to 3,100, provided we get above 30.50 and don't get back below it. So we won't go sideways above 30.50. I'm Vince. We'll see you in premium tomorrow and today and the next day. All right? Founders, you can look for the actual Goldman analysis today. Have a great day.
Well, thank you to Vince for this morning's report. Sure hope you enjoyed that one at home. And I will just say I sure enjoy watching Vince myself, and darn grateful that it's worked out with this setup that we have here. And glad to have all of you joining us every day, and hopefully it's been helpful along your journey as we watch the metals continue to rally. And certainly started last year and continuing on. And before we wrap up, I would just like to thank Fortuna Mining, who was our proud sponsor of today's show. And Fortuna actually just updated their mineral reserves and mineral resources estimate, which included inferred mineral resources of 2.2 million gold equivalent ounces, measured and indicated resources exclusive of reserves of 1.5 million gold equivalent ounces, which were increases of 29 and 36%, which were the result of infill drilling and the discovery of a new inferred resource that represents 741,000 gold equivalent ounces. Proven and probable came in at 2.7 million gold equivalent ounces, which was down 11% on the year, although the driver for that was the production that they had in 2024, which was record production for them, and also that depletion offset by the upgrading of resources to reserves, representing 204,000 gold equivalent ounces. Although fortunately, in terms of finding some more gold out there, Fortuna had some more news as they have intersected 7.2 grams per ton gold over 31.5 meters at their Kingfisher prospect in the Seguela mine. And they also mentioned that at the Sunbird deposit, which is really one of the most promising ones they have there, and they are getting closer towards mining. And there, the deep exploration drilling tested the southern extent and has returned to excellent results, including 4.3 grams per ton gold over a true width of 23.1 meters. So I will leave the link to both of these in the description field below. And for a little more color on the update to the mineral reserves and mineral resources estimate, well, that one is coming your way now. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.